Rohr here with an early global view on Thursday, March 19th, 2015. It's currently 7:35 a.m. We're coming to you a bit later than usual because we thought it'd be an interesting exercise after yesterday's FOMC indications to see how U.S. jobless claims came in this morning, and they were about as expected at 291,000. More important is that there wasn't much overseas data Thursday at all, and that was after the major influence from the FOMC yesterday. And that was pretty much just as expected. If you read our concise comment from Wednesday morning regarding the fact, yes, the Fed was going to remove the patience language, but much as when they removed considerable time, they were going to substitute something that was also accommodative in deference to the recent week data. So, what does all this mean to the markets? Well, in the first instance, that still very accommodative Fed stance, lowering projections in order to remove patience, but show they're not at all impatient. The lowered projections for economic activity and interest rates was the same thing as being very accommodative. So all the fear over the last week or so, especially into earlier yesterday on the pressure on the market back below the key 2062 to 58, into it, going back to Wednesday morning before the bounce, then pressure all day yesterday until we heard the actual statement and saw the projections out into 130. Well, that was all just so much short-term nerves. And you'll also note this was the topping line on the trend up from the low down at the 2032 area. This was the equivalent of about 2039 in the lead contract going back to last week Wednesday. And the overall up channel, all the market did through all of the churning earlier this week was work its way back down right around the channel support area prior to the announcement. Now, if it had been more hawkish, maybe it would have broken down. But in the event, of course, it got explosive back up out of 2060, right back through 75 to 78, back above 2088.70, an important area because of that being the old all-time high from back in December before the market pushed up after the first of the year. And here we are with a market that has now seen the hourly MACD push out above its upper runaway band and put in some upside acceleration right around that old 2088.70. So on any pullback, we'll be looking for maybe a dip back below this area, but the immediate supports are going to be back around 2081 on the Fibonacci, and of course back into the mid 2070s. So we'd say something on the order of that 2075 to 78, which is also the violated Fibonacci 2/3, as the June contract we're looking at takes over as lead contract today at the close of business. If it should continue higher, you've got higher resistances up into 2105 or so, and of course the old lead contract highs up at 2117. So those are the higher levels we need to keep an eye on. And that pretty much does it for the short-term view of the S&P 500.